It's been a brutal couple weeks in the stock market, hasn't it? In fact, you probably feel like this.
We're gonna die, man! There's some freaky stuff happening here. We're all gonna die!
Relax. Okay, that's what I'm here for. I'm debt-free Joel, and I'm going to give you 3 reasons why your portfolio probably hasn't been doing well over the last couple weeks. To give you guys an idea, the reason why I'm able to talk about this, and I'm not just some random head on YouTube or Instagram talking about this, is number one, I've been investing for 15 years. So I've seen, markets go up and down, left and right for a really long time. Number 2, I do have an MBA in finance. And number 3, I do hold the CFA designation. So what that basically means is I do know a little bit about investing. Stay tuned. So reason number 1 why your portfolio is probably down over the last couple weeks is that if I close my eyes and were to point to your portfolio, chances are I would see a bunch of tech stocks. So think about Apple, Microsoft, Tesla, biotech, all these different type of companies that you've been riding the wave on since last year have now been punching you in the face. And that's the point. You have no diversification in your portfolio. You're putting all your eggs literally in one basket. If I were to compare this to the index, for example, let's say the Nasdaq, you would see that you have been underperforming that index. Now, if you don't know what the Nasdaq is, it's perfectly fine. Let me explain. The Nasdaq is basically all the companies that trade on the Nasdaq. I know, simple, right? But most of them are technology stocks. Most of them are like, biotech, those type of things. So if the majority of your portfolio is in that index and the majority of the index goes down, what do you think is going to happen to your portfolio? It's going to go down. It's usually composed of about like 3,000 stocks, but the majority of them are tech. So that's what I mean by the Nasdaq. The Nasdaq is just a compilation of all the investment stocks that you have. Chances are they're all going to be probably tech. So if you're buying a lot of tech stocks, you probably have a lot of exposure to that index. And that's probably a big problem. You see, if you're underperforming the index of where your stocks are and you're only overinvested in one index, chances are you're going to get beat up. If all the Nasdaq goes down at the same time, chances are your stocks are going to go down at the same time because you're invested in the index that these stocks are in. And stocks usually perform worse or better than the overall index. That's the point. The index is that you hold everything. So the first thing you need to do is look at your portfolio and realize that you probably are investing in the same stocks all over the place, which means everything moves in the same wave, and that when people take profits, they're going to beat up on the stocks that you've been owning. So do you really need to own Amazon, Apple, Microsoft, Tesla, all of them at the same time? Maybe you own 2 of them. Maybe you own 1. Go into other industries. There's so many other industries. There's consumer staples, for example. You can go into energy. You can go into other things that probably did well over the last couple of weeks that you don't know about. So that's reason number 1. Stop only investing in tech stocks. Stop only investing in penny stocks. Stop only investing in one specific sector. Diversify your holdings and pick the best stocks in each of those individual sectors. You're going to be better. So the second reason why you're probably losing money right now is because you're suffering from what's called loss aversion. In finance, what it basically means is that you're going to hold on to a shitty stock that you probably had no reason buying in the first place because you don't want to recognize the loss. And you know what's making it worse? Every day you're watching it drop and it's starting to hurt you. Think about it. You're starting to feel anxiety. You're starting to feel stressed about it. This goes to a deeper level though. The problem is that you're probably investing money that you have no business investing. In my personal opinion, you should only be investing money after you have 3 to 6 months of savings saved up. The reason why is because if you start to lose money on it, you're not going to feel like there's a catastrophe. So take a look at your portfolio, take a look at your savings and start to think about, do I have enough saved up so that if something were to go wrong in the market, as it's doing now, I can withstand the hit? The second thing you want to do is take a look at your holdings and say, okay, what stocks do I have here that I took a gamble on, that I didn't do any research on, right? If you didn't do any research on the stock, you just felt good about it, you bought it, it went up, it felt great, and now it's tanking, take a look and see, all right, should I just sell these because I didn't do my homework on them the way I was supposed to? And then get rid of them. Don't suffer from loss aversion. Don't keep holding on to a terrible stock just because you don't feel like you want to take the loss. Sometimes you need to get out the crappy stock. The third reason why you're probably losing money is because you're not indexing. So you may have heard this term indexing, right? What it basically is that you buy whatever the market is giving you that day, right? You buy the entire index. So for example, if you were to turn on CNBC on a Monday, for example, and it said the market's up 0.5%, if the majority of your portfolio is indexed to that S&P 500, the majority of your portfolio goes up 0.5%. It's basically buying the entire index. You're not trying to buy individual stocks. You're buying everything. Now, the good part about it is that you're not sitting there trying to choose stocks all day long because you may have things to do. The bad part about it is that even in the index, you're going to have crappy stocks that you have to own. But that's what indexing is basically buying the entire index at once. You can do this via a mutual fund. You can do this via an ETF, for example. But a lot of people do it and a lot of people swear by it. I absolutely love indexing because at the end of the day, you just follow the market returns. See, one of the things that I love about indexing is two different things. Number one, indexing, if you just look at like what the stock market has done over the last 100 years, it's averaged about 7 to 10% depending on who you ask and what index you're looking at. So allowing that to compound over time is an easy way for you to become a millionaire very quickly. This is why the majority of us in the United States at least who become millionaires, they become millionaires through their 401k and not anything else, is because they allow it to compound over 30 years. But the second reason why I love indexing is because I got things to do. I'm not going to sit there in front of a screen all day long looking at stocks. Like that's not what I want to do all day long. It's going to cause too much stress, going to cause too much anxiety. And for those of you that don't know, trying to pick your individual stocks over time, normally you underperform the market. So I don't want to sit there and do this all day long. Indexing allows me to take whatever the market gives me and to compound over time. Now, for me personally, I have my portfolio about 75-25. So what I mean by that is 75% of my portfolio is indexed. Maybe I have some of it in the S&P 500. I have some of it in international markets. But then I take the next 25% and then maybe I'll invest it in individual stocks or take a little bit more risk on certain things. But remember, even in that bucket, I'm diversifying. So when you have weeks like this where the market's not doing well and everybody's freaking out, for me, I can barely see it as a blip on the screen because I'm thinking about 30 years from now. So remember, indexing isn't bad. Certain people feel a way about this, but for me personally, the stats don't lie. Just follow the market returns, let your returns compound over time, and you can start to build some real wealth. So I'll leave you with this little tip. I'm not in the business of giving stock tips because most of these people on here who give you stock tips have no idea what the hell they're talking about. But I just want you guys to think about this. Normally, when you invest in stocks, you're thinking about where the stock is going to go, not where it is now, right? Where the market's going to go, not where it is right now. So think about it. The majority of people around the world right now are taking vaccine shots. They're trying to figure out ways to open up economies around the world. In New York, they're starting to open up restaurants and things like that. Where do you think you see the market going? You see, in my personal opinion, people want to get the hell out of their apartment, want to get the hell out of their house, right? So you're going to see people fly more. You're going to see people try to go out more. You're going to see people spend more, right? So where do you think that money from an investment standpoint is going to go? Chances are it's not going to be in these tech stocks. In fact, for the majority of you, if you've been reading the paper, you saw this coming. In November of last year, they started to talk about how institutional managers, for example, people who manage money as a profession for a living, started moving their money out of tech and going into other industries. So it shouldn't be a shock now that you see tech stocks actually underperforming. But remember, your investments are where you think your investments are going to go, where the actual companies are going to go. Do you really see people still investing in tech stocks when the market starts to open? Do you see people still day trading when they're trying to be on vacation? I'm not into giving you stock tips, but think about it. Everybody and their mother is probably going to want to go on vacation. Everybody and their mother is going to want to start to travel. Everybody and their mother is going to go and want to spend money on new clothes and new things. So don't always leave your money in tech stocks all day long. Sure, they've been having a great run, but at the end of the day, do you see them still having a great run 2 years from now, 3 years from now, 5 years from now? Maybe, maybe not. But your investment should be where you think the market's going to go, not where it is right now. I'm Debt-Free Joel. Feel free to follow me on Instagram. Feel free to follow me on YouTube. I'm just here to hopefully give you guys some information. And always remember that a part of all that you earn is yours to keep. I'll see you next time.